Good evening, sir.
Okay, yeah, thank God we are back today. It's a privilege that we are here again this week. We got control over nothing in this life. All right. Our class tonight on performance management. We shall be looking at divisional performance evaluation. Now, a brief introduction into this topic. The topic is about evaluating the performance of divisions. For example, if you have companies that are operated along divisional line, a good example is Dangote groups. If you look at Dangote groups of company, under the Dangote groups, we have Dangote Cement, we have Dangote Sugar, we have Dangote Salt, we have Dangote Food, Dangote Flours, and we have Dangote Petrochemical. These groups or these divisions contribute to the total profit of the company called Dangote groups. Now the question is, how do we evaluate the performance of individual division within the group? This is what this topic is trying to address. Divisional performance evaluation. Another example is company like John Holt. If you look at John Holt, you have John Holt Yamaha, you have John Holt Ventures, you have John Holt Leasing, you have John Holt Agric, you have John Holt Car Rentals. This company is operated along divisional structure. And each division contributes to the total profit of the company. The question is, how do we evaluate the performance of each division? I won't try to bring closer to us what the topic is all about. Let us go into the discussion regarding this topic. Divisional performance evaluation. Let's try to expand this a bit. Let's take this to 14, okay? Also, let's expand this. I think better now. You can see the screen clearly now, or boldly now. Just 1 minute. All right, I'm fine. I was trying to pick my glasses. All right. Divisional performance evaluation. What is divisional structure? Or how do we define divisionalization? Divisionalization involves the decentralization of decision-making powers to divisions. Divisionalization involves decentralization of ends. The division achieves some level of independence and autonomy. Divisionalization, we say, is the decentralization of decision-making powers. So the various divisions in such a way that each division achieve some level of independence and autonomy. A divisional company is the organization and operations as segment autonomous units with a let's take that again. Is a company organizations are segmented. Be autonomous units. We have explained what is divisionalization. To mean a company whose organization and operations are segmented into semi-autonomous units. Each unit is referred to as a division. Each unit achieves some level of independence. Each division can take decisions within its own organization, within its own division. That is the concept of divisional structure. What are the benefits of divisional structures? What are the benefits of divisional structure? Or what are the gains of divisional structure? One of the go Congress. To ensure go Congress, to increase motivation of management, to reduce
Is it just
for division?
So your network is breaking. I thought
Not
I was the only one. No.
It's not only you.
My network. Please look at your network.
It's your network, sir.
It's your network, sir.
It's your network, sir.
It's your network, sir.
But we are back. We want to believe that the network will be stable now. All right, let's go on with the business. Let's take the explanation again. Divisionalization involves decentralization of decision-making powers. So the various divisions within an organization in such a way that each division will achieve some level of independency and autonomy. And each division is allowed to make decisions within its division. That is the concept of divisionalization. Now we are explaining the objective of divisional structure. Why do company operate along divisional structure? Or what are the benefits of operating your company along divisional structure? We explain one, that one of the objectives is to enhance goal congruence. Number two, to increase motivation of management. Number three, to reduce head office bureaucracy. Company can operate divisional structure so as to reduce head office bureaucracy. Number three, divisional structure provides a better training ground for junior and middle management staff. Then number three, then number five, it improves strategic decision making. Where a company is operated along divisional structure, this can improve strategic decision making. These are the objectives / benefits of divisional structure. All right. What are the disadvantages associated with divisionalization, or where a company is operated along divisional structure? What are the disadvantages? Number one is suboptimality. The major disadvantage of divisional structure is the potential for dysfunctional decision making. The major limitation of divisional structure is the potential for dysfunctional decision making. What does this mean? When we say suboptimality, all right, away. Let me explain suboptimality first. Suboptimality means a situation where a division make decision not in the best interest of the company. Where a division take a decision that is not in the best interest of the company as a whole. That is suboptimality. It's very possible to have your division in Abuja and the head office is in Lagos. You have a corporate head office in Lagos and the division is located in Abuja. At that Abuja, we have a divisional manager in Abuja. This manager can take decision that is favorable to the division, but not in the best interest of the company as a whole. That is what we call suboptimality. Dysfunctional decision making. All right. Please allow me to go back to a question. Somebody asks that, okay, Amarashi asked, not somebody, let's put a name to it, that we should throw more light on reduction in head office bureaucracy. How does divisional structure helps to reduce head office bureaucracy? What is head office bureaucracy? Head office bureaucracy means in head office, decision making will be slow. You have so many top level managers. Decision making will go through so many stages. And this could lead to delay in critical decision taking. If you look at most head office, you have so many top level managers or top level management. Decision will move from one stage to the next stage, from one point to the next point. And this could delay decision. This is what we refer to as head office bureaucracy. But if you're in a division, you have less manager, maybe just one manager is in that division. That manager is allowed to take decision on his own. He does not need to refer to corporate head office for all decision. The manager at the branch or at the division is allowed to take decision, to take some decision. This means that this manager can take decision quickly on some issues. But if this matter is referred to corporate head office, it may take longer period. This is what we refer to as head office bureaucracy. I hope that point is clear. Thank you, Amarachi, for that question. When you ask question, you are not only asking for yourself, you are also helping others. All right, let's move on. So what we are saying is divisional structure can reduce head office bureaucracy. It can enhance decision making quickly. All right. I hope that point is clearer now. Let's continue. We are on the disadvantages of divisional structure. We have explained the first point, suboptimality. God be the glory. Now the next point, increased cost. Divisional structure or divisionalization can lead to increase in the overhead cost of the company. Divisional structure or divisionalization can lead to increase in the overhead cost of the company as a whole. This is because common functions or common activities are duplicated at division level. Activities that are common to division can be more effectively managed from the central head office. Let's explain that briefly. Common activities are duplicated at divisions. What are common activities? HR. If you look at Dangote, Dangote is operated along divisional structure. We have Dangote Cement. Dangote Cement has its own HR department. Dangote Sugar has its own HR department that is going to source staff for Dangote Sugar. Dangote Salt also have HR. Dangote Petrochemical also have HR. These are duplications of common functions, and this will lead to increase in the overhead cost of the business. This is a limitation of divisional structure. Then number 3, loss of control. Where a company is operated along divisional structure, the top management at corporate head office will not have firm control over divisional managers. The top management seated in head office, divisional managers are different divisions, different locations. The top management will not have firm control on the activities of the divisional manager. And that's a major concern, where the divisional manager can act on their own. And the top level management seated in head office will not be aware. All right. We have also discussed disadvantages of divisional structure. Now the question is, how do we address this problem? It is very obvious that some company will operate along divisional structure, mostly conglomerate companies. Let me ask the class, what is conglomerate? What is conglomerate company? Let me ask the class.
Okay, let me try some.
Conglomerate. Yes, please. Who is speaking?
Yeah, Kunle, sir.
Yeah, Olakule, how are you doing?
Hi, sir. So
All
a
right.
conglomerate is a large organization that has several divisions that engages in activities that are separate or unrelated, to each other.
Oh, bless you.
Yeah, that's it.
That's it. A conglomerate is a company with several divisions involved in unrelated businesses. When you say a company is a conglomerate, you have several divisions, but these divisions are doing what? Unrelated businesses. Like Dangote now. Cement business is not related to petrochemical business. Cement is not related to Dangote spaghetti or Dangote drinks. All right, let's move on. Now, we are saying that there's a lot of benefit if you operate your business along divisional structure. At the same time, there are some disadvantages. And the question is, how do we address these problems? To address this problem, the company must introduce a suitable system of performance evaluation to address the problems associated with divisional structure. The company must introduce a suitable system of performance evaluation. The performance evaluation should be able to address the following objectives. The performance evaluation method should be able to address the following objectives. One, the performance measure must promote goal congruence, meaning the objective of the division must be in line with the objective of the corporate head office. Number two, the performance evaluation method must encourage initiative and motivation. Must encourage initiative and motivation. Next, our performance evaluation method must provide feedback to management. Any performance evaluation method we are trying to introduce must provide feedback to management. And lastly, our performance evaluation method should encourage long-term view. It should look at the long-term objective of the company. It must not focus on short-term achievements. All right. So we must introduce performance evaluation method. Now, to achieve the highlighted objective, what are these objectives? Promote goal congruence, encourage initiative and motivation, provide feedback to management. To achieve this objective, company must introduce responsibility centers and responsibility accounting. To achieve the objective of addressing the problem of divisional structure, company must introduce responsibility centers and responsibility accounting. Please, you have to follow that logic and the sequence. We need to address a problem, or we need to address problems. We must introduce performance evaluation. The performance evaluation must achieve some objective. Now, to achieve this objective, the company must also introduce responsibility centers and responsibility accounting. Now, the question is, what is responsibility center? What is responsibility accounting? Let me start with responsibility accounting. In responsibility accounting, a designated individual, that is a specific manager, is given the responsibility for a particular aspect of the company's budget. I will take that again. In responsibility accounting, when you say responsibility accounting, it means a designated individual, in brackets, a specific manager, is given the responsibility for a particular aspect of the company's budget. And within the budgetary control, system, the manager is made accountable for the actual performance of the responsibility. Within the budgetary control system, the manager is made accountable for actual performance of that particular aspect of the budget. Let's put an illustration to this. If you look at Equity Professional, it's a company, and we have a budget. What's our budget? What we stand to achieve. What do we stand to achieve as a company? Our mission statement is to produce chartered accountants. That's our budget. Our primary budget is to produce chartered accountants. Now, within this budget, the budget is divided into 3 categories. We have the foundation budget, we have the skills budget, we have the professional budget. Now, within the skill budget, we have sub-budgets. We have performance management budget. Asiwaju and Adejuwon is responsible for performance management budgets. Look at it. Specific or designated individual is given the responsibility for a particular aspect of the company's budget. Asiwaju and Adejuwon, we are responsible for performance management budgets. And we will be made accountable for the actual performance of these budgets. That is responsibility accounting. A designated individual is given a particular responsibility in the company. And that individual is made accountable for that budget, actual performance. Management will not ask me about FR. Management will not ask me about tax or audits. But management will ask me about performance management. Is that clear, please? That is responsibility accounting. If you look at your office, you have your job function, and you are responsible for this job function. Management will question you on your job function. That job function that is tied to you is called responsibility accounting, where a designated individual is given a specific task in the company, and that individual is made responsible for that task. That is responsibility accounting. I hope that point is very clear. Now, the next is responsibility center. Our next discussion is responsibility center. Responsibility center is the area of operation for which a management is responsible. Responsibility center is the area of
I can't hear you anymore.
Same here.
Same here. Oh.
I'm surprised. My system went off. As if they are trying to hack into my system.
Sorry about that.
I'm not surprised.
Don't allow them,
As if,
sir.
I don't know, as if intruder is trying to hack into my system. My system just off itself. I don't know. Are you sure we don't have hacker around us here? All right, let's go on. Anyway, yeah, we are trying to explain responsibility center. We said is the area of operation for which a manager is responsible. We can also define it as a department or organizational function whose performance is the direct responsibility of a specific manager. According to Chartered Institute of Management Accounting, a responsibility center is a department or organizational function whose performance is the direct responsibility of a specific manager. Let me throw more light on that. Let me throw more light on that. This guy will not allow me rest. You know when you drop message on the chat, I'll be forced to go and look at it. Whether it is relevant or not, I have to check it. There's no financial application on my system. I can't put it there. All right, let's explain that briefly. When we say responsibility center, it's actually a department that takes responsibility for a particular operation, like account department. Account department is a responsibility center. That account department takes responsibility for account functions. Admin department is a responsibility center. Admin department takes responsibility for a specific function. All right. Sales department is a responsibility center. Sales department takes responsibility for a specific operation of the company. Okay. Basically, there are three types Basically, there are three types of responsibility centers. These are one, cost center. These are one, cost center. Let me explain this. A cost center is a department or a section or a function over which a designated individual has responsibility for expenditure. Please listen carefully. A cost center is a department or a section or a function over which a designated individual has responsibility for expenditure. When you say a cost center is only allowed to incur cost. A cost center can only incur what cost. This department is not allowed to generate revenue. It's a department for accumulation of cost. Please note that. And please note this. A division cannot be a cost center. A good example of cost center is admin department. Admin department, that is administrative department. These departments only incur cost. If you look at most admin departments, they will purchase diesel, consumables, toiletries, and what have you.
Stationaries.
Service car. What do you say, sir?
Stationaries.
Stationaries. They are only to incur cost. Please note, I will repeat it. A division cannot be a cost center. Number two, profit center. A profit center is a business segment by which cost and revenue are controlled. A profit center is a business segment that has authority to incur cost and generate revenue. This business segment can determine its own profit or loss. The manager of a profit center is held responsible for the profitability of the operation under his control. Is that point clear? In a profit center, you are allowed to generate revenue. You are allowed to incur cost. Hence, you can determine your own profit. And the manager in a profit center is held responsible for the profitability of the operation under his control. Please note, a division can be a profit center. If you look at Dangote Cement can incur cost and it can generate revenue. Hence, Dangote Cement is a profit center. If you look at Dangote Salt can generate revenue. It can also incur cost. Hence, Dangote Salt is a profit center. Number 3, investment center. The investment center is a business segment that has the authority and responsibility to generate revenue, incur cost. In addition to this center can make investment decisions. Let me take that again. An investment center is a business segment within an organization that is authorized to incur cost, generate revenue. In addition, this center can make investment decisions. The center can invest in assets. Hence, we can relate the profits to the investment employed. That is the concept of investment center. Please note, a division can be an investment center. A division can be an investment center. For example, Dangote's cement can be an investment center. This division can incur cost, can generate revenue. The division is also allowed to make investment decisions. In that case, that division will be regarded as investment center, where you are allowed to make investment decisions within your division. Now, like I said, we have three types of center, but I can introduce one more, which is revenue center. Revenue center. A revenue center is a department or a section within an organization that is only allowed to collect revenue or to generate revenue. In a revenue center, there is no measurement of cost. You cannot incur cost. You are only allowed to generate revenue. You can't spend the money. Your responsibility is to generate revenue and bring in money. But you are not allowed to incur cost. Hence, you cannot determine profit. Please note, a division cannot be a revenue center. Please note, a division cannot be a revenue center. All right. To this side. Yes, Olakule, you can ask your question.
Hello, sir.
Yes, we are listening.
Okay, so would it be right to say that responsibility center exists in the scheme of the organization as a whole, while responsibility accounting exists in the scheme of a division? And would it also be right to say that while responsibility accounting applies to a divisional manager. Responsibility center applies to a departmental head. Would it be right to say that?
Please, can you take that first one? Will it be right to say?
I said, would it be right to say that responsibility center applies in the scheme of the organization as a whole, while responsibility accounting applies under a division?
Responsibility center do not only apply within an organization, but maybe what you are trying to say is responsibility accounting is a subset of responsibility center. Maybe what you are trying to say is, when you say responsibility center, we are looking at the department now.
Yes, sir.
In your department have a specific job function. Let's assume you are in account department. That account department is a responsibility center, because you take responsibility for the account functions of your company. Now, if you now get to that department, under account, we have subdivisions. We now have final accounts. Maybe we also have receivable accounts. Maybe we have debt recovery account session. Now, within the account, now we have final account preparation. Some people job function within the account department is to focus on account preparation, final account preparation. If your job function is to focus on final account preparation, that is responsibility accounting now. That is what management will ask you question about. If another person's job function, say Amaraki is also in accounts, and his job function is she's in charge of sales receivables, to monitor our sales receivables. That means our job function is that is what management will question me about. That job function of yours is responsibility accounting, whereby a designated individual take responsibility for a specific job function, and that individual is made responsible. So what am I trying to say is, responsibility center is like the proper set, while responsibility accounting is a subset. I don't know if it's clearer.
Yes, sir. Yeah, where I'm having issues is in the explanation. When you said when we are talking about responsibility accounting, that a specific individual is responsible for all the activities that goes on in a particular division
No,
as it
not
relates
the activities. No.
Okay.
I didn't say all activities. Do I say so?
Okay, maybe I'm
not sure I
missing
said so. I'm not sure. I said responsibility accounting, a designated individual is given a specific aspect of the company's budget. I've never said individual take responsibility for all actions. No. A designated individual is giving a specific aspect of the company's budget. That was what I said. Is that clear, Kule?
Yes, sir. Thank you, sir.
Oh, okay. So now, how do we evaluate performance of deviation? We can use financial performance measure. To evaluate the performance of deviations, we can use financial performance measure. One of these measures include one, return on investment. Your return on investment relates profits achieved to the resources invested in a division. Let's take that again. Return on investment relates profits achieved to the amount of investment, to the amount of resources used in running a division. So we can use return on investment to measure the performance of a division. This is calculated as operating profit divided by capital employed multiplied by 100. This is calculated as operating profit divided by capital employed multiplied by 100. Please note, your operating profit is profit before interest and tax. Please note it. You can note it somewhere. Your operating profit is your profit before interest and tax. Your capital employed can be defined in different ways, but you are going to get the same result. Your capital employed is the total amount of investments. Your capital employed is the total amount of investments in a division. You can calculate this as total assets less current liabilities. You can calculate this as total assets less current liabilities. All right. At times, please listen to these 2 points. At times, you might be asked to evaluate the performance of divisional manager. Please listen to these points clearly. At times, you might be asked to evaluate the performance of the divisional manager using return on investment. In this case, the formula will be adjusted slightly. Deliberately, I'm trying to keep the pace cool. I say, look at the point. To evaluate manager's performance using return on investment, the formula becomes controllable profits divided by divisional capital employed multiplied by 100. What is controllable profits? Look at it here. Controllable profits. Look at it here, please. This is the profit derived by the manager after deducting all costs within the control of the manager. Controllable profits. This is the profit achieved by the divisional manager after taking care of all costs under his control. So please note that. If you are asked to evaluate the performance of a divisional manager using return on investment, you are going to determine controllable profit. You are going to determine divisional capital employed. These two variables will be used to calculate return on investment. Okay. Now, to evaluate the performance of division, there are two different things. Performance of divisional manager is different from performance of the division. If you are asked to evaluate the performance of the division, you are going to, using return on investment, the formula becomes traceable profits divided by divisional capital employed multiplied by 100. What is traceable profits? Look at it here, please. Traceable profit is the profit achieved by a division. Profit achieved by a division after taking care of all costs that are traceable to the division or used by the division, whether within the control of the manager or not. Whether the cost is within the control or not, you are going to deduct it. All right, we are done with the first method. Any question? Any question? Number 2 method, residual income method. Residual income is calculated as operating profits minus notional interest. You can adjust this as your residual income is equal to operating profit minus, open a bracket, capital employed multiplied by costs of capital. Yes. Notional profit is also called imputed interest. Is the return given to the suppliers of funds and is calculated by applying cost of capital on net investment, capital employed. The idea behind this computation. Please listen to this point. Our residual income is calculated as operating profit minus brackets capital employed multiplied by cost of capital. Please note, capital employed multiplied by cost of capital is what we call notional interest. It's also called imputed interest. Please listen to this. The idea behind this calculation, the idea or the logic behind this computation is that at no time should the interest paid on funds used be more than profits made. At no time should the interest you are paying on funds used be more than the profit achieved on your business. Is that clear, please? You go to borrow money or you obtain finance and you are going to pay a cost of 15% and you are making a profit of 10%. Will you borrow that money? It makes no sense. It doesn't make sense to borrow that money and invest that money. At no point in time should the interest paid on funds be more than the profit made in that period. If this happens, the manager or division is doing badly. That is residual income. Now, to round up this, to evaluate manager's performance, if you are required to evaluate manager performance using residual income, you are going to adjust this. This is equal to controllable profit. We can simplify this. Minus notional profit, notional interest on controllable investments. You are going to get your controllable profit. Then notional interest, that is cost of capital multiplied by controllable investments. To evaluate the performance of division using residual income, the formula becomes traceable profits minus notional interest on traceable investment. All right. Our explanation will stop here tonight. We have taken almost 1.5 hours explaining. We are not going to touch economic value added tonight. That's another topic entirely. Our explanation will stop here tonight. Any question? Any question for me? Oh, let me even check. If there's no question for me, it's obvious I will have question for you anyway. So let's get ready. Let's wait. All right, illustration 1. Any volunteer to read, please? Illustration 1.
Define the following concepts.
Okay, who
One,
is reading, please?
joy.
Oh, Joy.
Okay.
All right.
Okay. Define the following concepts. Responsibility accounting, an investment center, return on investment, residual income.
All right,
Should I
let's
continue?
take, that is for 4 marks. No, please, let's answer the first one. Requirement A says, define the following concept. This was the question for November last diet.
Yeah.
Please define for us responsibility accounting. Any volunteer?
I think still joy. I think it's responsibility accounting is like when a manager is given a responsibility for to do a particular aspect of the budget or something like that. So they are made accountable for the area that they've given them responsibility for. I don't know if I'm even saying the right thing.
At least. All right, any addition? Any addition to support Joy?
Hello, sir.
Yes, please speak in place.
Yusuf.
Oh, Abubakar.
Yes, sir. So, responsibility accounting is the designation of a particular aspect of a budget to a manager.
Okay. So can somebody refine it more better?
Okay, sir. So I would say responsibility accounting is a term that is used to describe a condition whereby a specific manager is assigned responsibility or takes responsibility for a particular aspect of the company's budget.
Okay, we all tried. That when we say responsibility accounting, is a situation where a designated individual is given a specific aspect of the company's budget, and such individual is made responsible for the actual performance of that aspect of the company's budget. All right, thank you. Number 2, investment center. Who will explain to us? We have to answer this before we move to the next one.
Hello, sir.
Yeah, we're speaking.
Hello, sir. Yeah, this is Toib, sir.
Oh, Toib.
Yes, sir. An investment center. An investment center is a center that is responsible for investment decision. Then the center can also incur costs and also generate revenue.
All right, that's fine. At least was able to bring out the 3 points. An investment center is a business segment that has responsibility to incur cost, generate revenue. In addition, this center can make investment decisions. That's fine. Now, next, return on investment. What do you understand by return on investment?
Profit all over capital employed multiplied by 100.
Okay. Okay. But we have not defined it. So.
Okay, so I think return on investment basically is like the returns or the profits that we gain from any investments that has been made.
Okay.
Yeah.
Okay. Any addition? Profits made on
is
investment.
Hello, sir.
Somebody is speaking. Yeah.
Yeah. It is the unit of profit that is attributable to unit of investment in the organization.
Okay. It is profit attributable to amount of investment in a company. That's fine. All right. They can now say return on investment is a performance measure that relates profits achieved. Please listen. You can note down. Return on investment is a performance measure that relates profits achieved to the amount of resources invested in a division or a project. It is calculated as operating profits divided by or all over capital employed multiplied by 100. The higher the ratio, the better the performance. The higher the ratio, the better the performance. Now, lastly, residual income. What do you understand by residual income?
Operating profit less notional interest.
Okay, but I won't give you full mark. Oh. You have just given me definition of calculation, how to calculate it.
Hello, sir.
Yes, sir.
Hello, sir.
Yes, we are listening.
I think it is the excess income after the deduction of costs, the cost under the control of the manager in charge of that particular section.
No, you're already in line now. Why do you put control of manager again?
I'm trying to relate it to the subject matter. That's why I'm mentioning the manager. So it's the excess of income after the reduction of the cost incurred.
Residual income is excess of profits over cost of capital. Cost incurred to obtain capital. Residual income is the excess of operating profit over the cost of funds. The residual income is the excess of profits over the cost of capital or cost of funds.
Could it also mean, sorry, sir.
We are listening, no problem.
I said, could it also mean profit before tax?
Please, do not use profit before tax. So, what do you say now? Profit before what?
Before tax.
No, it's
Since
profit before interest. It's profit before interest and tax.
Okay.
Hello?
No, since operating profit is, you mentioned that operating profit is profit before interest and tax. So could residual income mean profit before tax? That is after removing interest from profit before interest and tax.
Oh, okay. So residual income means profit before tax.
Yes, sir.
Okay. But I'm being careful not to say yes. Do you understand? Because when you are computing your residual income, you are going to take tax in. By the time you get to residual income, you know when you want to come, if you are calculating your cost of capital will involve tax.
Mm.
Hello? If you
Yes, sir.
calculate cost of capital, that cost of capital, tax will be included. So I'm being careful not to say is our profit after before tax. But the appropriate definition is, because we want to measure performance, we are trying to look at excess of profits over cost of funds. Cost of funds is who and who has contributed money to finance the business. People that have contributed money, they will expect returns from their investments. If a company is not making enough profit to meet the return to provider of capital, that company will collapse. That company is not doing well. So I will not automatically say it is our profit before tax. I will stick to the rule. Is that clear? Is that clear, sir?
Yes, sir. Yes, sir.
So it is excess of profit over cost of funds. The cost of funds is not only interest. When we say cost of funds, it's not only interest. Cost of funds include interest and cost of equity. Interest is the cost of debt. And you also have cost of equity. So it is not profit before tax. Is that clear, please?
Yes, sir.
Aha. I want to explain this. Let us look at Roman figure B now. Or let us look at first. You can go ahead, Joy.
Okay, sir. Ingige and Sons Limited has 4 operating divisions.
Please pronounce this again. What is this?
Ingige and Sons.
Okay, I think it's an Igbo. Okay, I thought it's an Igbo pronunciation.
It sounds like Igbo.
Go ahead.
Ingige and Sons Limited has 4 operating divisions which are spread in 4 cities in Nigeria: Lagos, Kano, Gombe, and Enugu. Divisions are treated as investment centers for the performance.
Divisions are treated as investment centers for performance reporting. Please go ahead.
The following information is available. We have number 1, the divisional investments. For Lagos, we have 10 million naira. For Kano, we have 4 million naira. For Gombe, we have 3 million naira. For Enugu, we have 7 million naira. 2, the divisional sales. For Lagos, we have 53 million naira. For Kano, 23 million naira. For Gombe, 24.6 million naira. And for Enugu, 29.4 million naira. Number 3, divisional variable cost. For Lagos, we have 50 million naira. For Kano, we have 22 million naira. For Gombe, we have 23.4 million naira. For Enugu, we have 27.4 million naira. Number 4, divisional fixed costs. For Lagos, we have 1.5 million naira. For Kano, we have 750,000 naira. For Gombe, we have 600,000 naira. For Enugu, we have 800,000 naira. The company's annual fixed cost is 1.3 million naira, which is apportioned to the divisions on the basis of sales. The cost of capital. Sir, you said, oh, I'm even using a printout. The cost of capital for Ngenge and Sons Limited is 7.5%. Ignore taxation. We are required to 1, evaluate the performance of the divisions using return on investment method, residual income method, and reevaluate the residual income situation of the company, given that the cost of capital is 10%.
All right, thank you. The part A is for 4 marks. The part B is for 11 marks. Now let's go to this business. The question is very direct. We are to evaluate the performance of the divisions using residual income method, return on investment method. Then we are going to reevaluate the return on investment, return on residual income situation of the company using, given that the cost of capital is 10%. This question is 100% direct. Examiner gives us all the data required for computation. All right, let's move to the whiteboard. Let's see how far we can go with this question. For some, they document what we do on the whiteboard so as to keep them also active in the class. Please, let's try to do whatever we can to avoid sleeping, because it's not impossible that somebody will have closer to a system and is just sleeping. Why are you laughing now? Somebody will just put on a system now and just person is sleeping. It's human nature now. Please confirm you can see my board being shared.
Not yet.
Oh, not yet. Apparently, this is not shared. Let me go. God. Okay. Okay, confirm now that is good.
Not yet, shameful.
Not yet.
Okay. Good to go?
Yes, we
sir.
can see.
Work in progress.
It's good to go. All right. We move to requirement 1 or requirement A1, or let's say B1, sorry. B1. We need to calculate return on investment. We have to save this long writing. For me to do this, I require the operating profit and investment. Is that not, please?
Yes, sir.
For me to do this, I must get operating profits. So I'll have my division. Divisions. We have division in Lagos, Kano. We have division in Gombe and Enugu. Okay, the total for the company. Okay. Now, if you look at the question, we are not giving the profit direct. The profit ourselves. So take your sales figure, your sales value. Okay, let's assume we have 30 up. We have 30. We have 30 up. We have 30 up. We have 30 up. All right, let's go to the business. What is sales value for Lagos supply?
53,000.
Kano?
23,000.
Gombe?
94,600.
Enugu?
29,400.
Please, let's obtain total sales for the company.
Thank you.
We have taken the sales value.
130,000.
Thank you. Let's go to the variable cost. We are trying to calculate profit for these divisions. The variable cost, let's supply.
50,000.
Next.
22,000.
Next.
23,400.
Next.
27,400.
Total variable cost, please sum up.
122,800.
Thank you. Let me use red to do brackets. Now, while we are doing this, let's look for the contribution. Sales minus variable cost.
3,000.
3,000.
All right.
1,000.
No. 1,000.
Contribution 3,000.
1,100. 1,200.
1,000.
1,200.
1,200.
2,000.
2,000. Total contribution for the company?
7,200.
7,200.
Now, in this question, we have two fixed costs. We have divisional fixed cost and we have head office fixed cost. In this question, we have divisional fixed cost. We take that first. Divisional fixed cost is the fixed cost incurred by the division. Divisional fixed cost. Let's pick this out. How much?
1.5, 1,500.
1.5.
750.
750.
600.
How much?
600.
Good.
600.
800.
800. Total for
8,650.
3,650. All right. Now we are asked to calculate performance of the division, whether the cost is incurred or not. We have a cost incurred. Look at it. Look at the paragraph here. The company's annual fees cost of 1.3. This cost is not incurred by the divisions. It's not incurred directly by the division. It is incurred by the company head office. But the company says the company's annual fees cost of 1.3, which is apportioned to the division. Can you see it? It is to be apportioned to the division on the basis of what? Sales. Is that clear, please?
Yeah.
They say apportion it to them. That means we need to share this 1.3 million to the various divisions on the basis of sales value. Let's go back to our working. We come here, apportioned head office fees cost. The total amount is 1,300. We need to go and share. Now let's go to the next page to do this working. Please confirm you can see my screen too, my whiteboard too being shared.
Yes.
Yes, sir.
All right. I'll take that as working one. Apportionment of head office fees cost using sales on sales basis. So we have to pick the sales for the divisions. Oh no, I want to write Lagos. Lagos sales is 53,000. Kano sales is 23,000. Gombe sales is 24,600. Is that not?
Yes, sir.
Enugu sales is 29,400. Total sales for the whole division 130. Now I need to calculate the apportionment rate per sales. I will come here. Apportionments rate is equal to total amount, total cost, overhead cost. The overhead cost, fees cost is 1,300. The basis is sales, Abby.
Yes.
Is that
Sir.
not, please?
Yes, sir.
Total sales value is how much?
130,000.
Please calculate. This is the apportionment rate. This will give you 0.01. Is that not?
Yes, sir.
That's the apportionment rate. I can come back here and say multiply by 0.01. multiply by 0.01, multiply by 0.01, multiply by 0.01. Now, allocation here, what do you have here?
530.
This is 530.
230.
This is 230.
246.
This is 246. This is 296. Oh, 294. 294. If you sum up, it must give you back 1,300. You are done with the apportionments. Move back to your page 1. Just come here. 530. 230. 246. 294. We are going to subtract these two. Sorry.
Thank you, sir.
Joy.
Sir.
Now you can get your what we call traceable profit now. Traceable profit now. Contribution minus the two costs. 3,000 minus 1,500 minus 530.
970.
970. Next.
20.
20. Next.
354.
4. Next.
906.
906. For the company as a, what is the profit?
1,250.
1,000?
No.
2,000. 2,250.
2,250. You have gotten your profit now, traceable to the division. You now introduce investments, divisional investment now. Divisional investments. Please look at the question, supply divisional investments.
10,000.
Lagos is 10 that's 10,000. Kano how much? Kano 4,000.
3,000.
3,000. 7,000 invested in Enugu. Total investment for the company, please, sum all investment.
I think that's
24,000. We can now calculate return on investment. This is equal to our traceable profits divided by divisional. I'll just shorten the divisional investments. Multiply by 100. Oh yeah. Please work this and give us the figure.
That the traceable profit for Lagos is 970, not 973.
Oh, thank you for the correction. Now this will give us what?
9.7.
9.7%.
Yes.
Please go ahead.
0.5%.
11.8%.
12.9%.
12.9. For the company as a whole, what is the percent?
9.38%.
Approximately 9.4%. We have calculated return on investment. If you have to comment on this, compare the 4 divisions. Who is doing best?
Lagos.
Are you sure?
Sorry, no, Enugu.
Enugu is the best.
0.9.
Sir, the total return on investment.
What do you mean by total, please?
The total is 34.9, not 9.4.
Please don't hide. That would be suicidal.
Oh, okay.
Why are you hiding? You are going to now calculate 2,500 over. If you had it's actually suicidal. They will just cancel it with a relating bonus. What you are going to do is you are going to pick the profit here. That is, you are going to pick 2,250 divided by. Don't go hard.
Unpardonable error.
Oh, sir.
Unpardonable error.
So, if you have to comment on this, Enugu division is the best in terms of return on investments. All right. That is B Roma figure 1. Let's move to B Roma figure 2, residual income. Can you see my whiteboard being shared?
Yes, sir.
All right, let's move to the we move to B Roma figure 2. B Roma figure 2. You want to calculate residual income. At 7.5% cost of capital. You are going to state your division. We have Lagos. We have Kano. We have Gombe. We have Enugu. Then we have the company as a whole. Company as a whole, that is the total. Then you are going to, of course, to calculate residual income is profit minus notional interest. So I'll just come here. I'll pick the profit, the traceable profit. This is 970 for Lagos, 20 for Kano, 354 for Gombe, 907 for Enugu. Total is 2,250. I will now go and look for investments. Investments. multiplied by cost of capital. Now, without wasting time, the cost of capital is 7.5%. What is the investment in Lagos?
750.
No, what is the investment in Lagos first?
10,000, 10 million.
Okay, 10,000 multiplied by 7.5. That will give us
750.
750. That is the notional interest. Go to Kano. Investment in Kano is 4,000. 4,000 multiplied by 7.5.
300. No, sorry.
30,000.
Yes, 300.
Okay.
300.
300.
Not 30,000, please. 300.
Yes, 300. I didn't divide it.
Okay. 7.5% multiplied by investment in Gombe.
225.
225. Then 7.5 multiplied by investment, 7.5% multiplied by investment in Enugu.
525.
525. Now 7.5 multiplied by total investment. Total investment is 24,000. 7.5% multiplied by 24,000.
1/8.
1/8. You can get your residual income now. Residual income, please subtract.
220.
This is 220.
280 negative.
Negative 280. This division is not doing well. It's doing very badly.
129.
129.
29.
382.
382.
450.
450. You are done with the calculation. If you have to comment, in terms of residual income, Enugu is still the best. If you have to comment, in terms of residual income, Enugu is still the best. Then we move to the last aspect of the question. The question says, reevaluate residual income. Evaluate residual income using 10% cost of capital. The only thing that will change is our notional interest. We'll come here, our division, Lagos, Kano, Gombe, Enugu, then company as a whole. Pick your profit. $970, 20, 354, 907, and 2250. Then now I will now say investments. You can also shorten it notional interest, or let's be consistent, because some might not be on the class. They will now be looking at what we have done. Investments multiplied by cost. Now our cost is now 10%. The investment in Division Lagos is 10,000. 10% of 10,000 will give us 1,000. Is that not, please?
Yes, sir.
Investment in Kano is 4,000. 10% of 4,000 will give us 400.
400.
Investment in Gombe is 3,000. 10% of 10,000 is 300.
Okay.
Investment in Enugu is 7,000. 10% is
700.
700. Total investment is 24,000. 10% will give us 2,400. You can now get new residual income. This will give us -30. This will give us -380.
80.
This will give us +54. 54. This will give us
206.
207.
Oh, is it? Oh, it's my error. This is my error. We actually got 906. This should have been this is 6. So this will be
206.
This will be 1. This will go. And I'm trying to adjust. This is 1. This is 6. This is 206. This will be -150. Is that not?
Yes, sir.
We are done with the question. Any question, please? Okay. The management should be thinking of deleting Kano. Alternatively, they can try to see how to improve performance in Kano.
If Tinubu is the head of the management, he will not consider them. He will rather delete them because they like what. If Tinubu were to be the head.
No, I don't understand though. Tinubu. Okay, you mean Mr. Tinubu?
I'm only joking that if the head of the management were to be Tinubu, he will not even think of improving them, rather close them down.
Well, I'm assuming that we have many Tinubus.
I like that.
Of course, we have many Tinubus now.
Yes, now. But
because I'm sure you two are Tinubu. The man that is talking, I know him now, is Tinubu now. He shared a lot of blood with Tinubu. He shared a lot of relationship with Tinubu. I know him very well. And he can't deny it. I know the man very well now.
Hello, sir.
I know him very well. Yes, sir.
Can you comment on the cost of the capital? Because the cost of the capital of 10% here, almost 2 of negative performance here, while in the previous one is just only Kano.
Okay, we can comment. In fact, we can comment on this very well. That capital increased to 10%. The company as a whole, we not be doing badly. If the cost of capital increased to 10%, the company as a whole will be doing badly. We are almost done, don't worry. Just allow us.
Sorry, sir.
All right. I'm not sure we can take any question again in view of this time. So any question?
Hello, sir.
Yes, we are listening.
Is it possible that the examiner can ask us to comment on this the workings, or let me say on the solution?
Why not?
Like the kind of comment I'm talking about is might be a kind of advice to the company, or
and that's what we are saying now. Why not?
Qualitatively.
You can be asked to advise the company now. Have we computed? Kanu is showing that Kanu is not even doing well. It's reporting loss. In terms of return on investment, Kanu is still giving return of 0.5% on investment. For residual income, Kanu is not making enough profits to meet the expectation of providers of capital. Kanu division is not making enough profits to meet the expectation of the suppliers of capital. Now, what will be our recommendation?
I
Maybe
can
you have to recommend.
that the manager of Enugu should be taken to Kano to take over and apply necessary steps towards at least making Kano to become one of the good centers or divisions.
Okay. So what happened to manager in Kano?
They may not be taken away, but rather work with the new manager. If they can learn.
The junior, so it will be the junior. It will not be reporting to this.
Sir?
Don't you know that as they are bringing that man for Enugu, they will just kill him?
Exactly.
Assuming you are the one in Enugu, they not say go to Kano now. As you are coming, they will just plot to kill you.
It can't be me because you know it will not be me.
How are we even sure it's the fault of the manager in Kano? Sir, how are we even sure it's the fault of the manager in Kano?
Okay, what do you think should have been the problem?
I said, how are we sure it's the fault of the manager in Kano? It could be.
I agree with you.
It could. Yeah. It could be other factors.
Like.
Don't forget the topic is
climate. The environment. Not rest.
Thank you. Don't forget the topic is performance evaluation. Assuming you are an external consultant, and you get to Kano, you are giving these results, and you get to Kano, we now ask them that maybe it's not the fault of the manager. Is that what you're going to say?
But it's the division we are assessing now, not the manager. It's the division.
We agree.
Who is in charge of the division?
That's responsibility account.
Okay.
The
okay, please allow me. Assuming you are a consultant, and you are consulting for this company. You now get to Kano. What are you going to do to that manager?
I'm a for Palori,
No, I'm waiting for him.
Well, if I have to be in the position of the person that is to act on what is happening in Kano.
You are not in the position. Don't go back. You are in position now. You are the consultant.
Yeah.
First, I will look at the operating environment. Is the operating environment conducive for business?
You are going out of your work, you are going out of your
work. No, I'm not.
Let him speak. Let him speak.
Let me see.
I'll look at the operating environment. If I look at the operating environment and I see it's not conducive for the line of business, then I could advise that probably would move the division from Kano to another environment that is suitable for the business. That couldn't be the fault of the divisional manager.
Okay, but are we going to move the manager along?
Well, that's management decision, sir.
Okay. Okay, you have answered the question.
Hello, sir.
Yes. We are
listening. Okay.
Why not?
They would not even have situated that business in a Kano, because they must have evaluated the environment before like what comment somebody passed about Dangote, that Dangote have understood the nature of the people in the north and the east, why he left them to come and situate his refinery in the north. Because Dangote understood that the people in the north may not be able to be controlled when it comes to certain situations. A lot of damages will come. There are people that don't obey laws and whatever like that. So these are.
Do you know that this statement you are making? This statement, you need to be careful with statements.
Somebody made it online, not me. No, somebody made it online.
In my class?
No, as in the media.
Okay, because I
Not
know
true.
that Kanu you are talking about,
But
that
we can change the narratives instead of going far to the ethnicity issues. If for
okay.
Dangote,
I
Hello,
think
sir.
for Dangote,
Hello, sir.
I think
Philip, please let's allow that one to die for
I
this
think
Hello, sir.
purpose.
the
For this
the
Hello,
man
sir.
purpose.
might have hello.
Hello, please allow me to just round up. For this
All
purpose, it's
right.
very possible that first the manager will be put on all seats. Manager is likely to go down first,
Okay.
because for you to get to this point, you must have raised concern. Why are we not generating enough revenue? Maybe
Mm.
there is crisis peculiar to this environment, or maybe
Okay.
there is disturbance. Okay, that means at that point we understand that this is not only our Kano branch, it is all the company within Kano that is experiencing this reduction in profit. In this case, we cannot blame the manager, because the crisis is not within the control of any company. Like if you look at when we have the issue of crisis in the northwest region, maybe all those crises that we have, of course, companies within that region will not be able to transact very well, and that will affect income. That means this problem is not peculiar to this company. It's peculiar to all the companies operating in that environment. So in this case, we can say, okay, we still allow the division to run, because the crisis we face out. Crisis will not run forever. You don't quickly move your business out. The crisis will face out, and normalcy will return. If normalcy returns, we expect business to stabilize and company to return towards achieving profit. So it's better that way. We can stop it there. So
Yes, so I was trying to say that if the situation was not peculiar to all companies, we would have applied the SWOT analysis and PESTEL to know what is actually wrong with the market,
okay, that's
the
also
product.
fine. That's also fine. All right. All discussion. All right. Any other comments?
Hello, sir.
Yes, please.
When you were discussing ROI, you made mention of, I think at no point in time should the interest paid on funds be more than something. I didn't get that, and I don't think it's on the period.
Okay,
Yes.
that's a good point. At no point in time should the interest paid on funds be more than the profit generated. Look at it here, please. Be more than the profits generated. Look at it here. Investment multiplied by cost of capital. This is the interest paid on funds. Kano has gotten an investment of 4 million. And the cost of the investment is 7.5. Look at the interest paid on investment. The investment is the funds. Kano has gotten 4 million. And the cost of the funds is 7%, 7.5%. If you compute 7.5% of 4 million, that will give us 300. This 300 is the cost of funds. At no point should the cost of funds be more than the profit generated. Look at it. Look at this point. The cost of funds is more than the profit generated. Hence, that division is doing badly. Look at the badly. Negative residual income. Is that clear, sir?
Yes, sir.
That's what we are trying to explain. That is the situation of Kano now. The cost of funds exceed profit generated. Kano division is doing badly. All right, thank you for your time. Thank you for the input.